Hey everybody, David Modell looking at the markets. I just wrote this. Let's see if you agree with me on this one. Let me know in the comments. Do you agree? Do you disagree? The Fed can never raise bond yields again, ever. I'm exaggerating a little bit here. Let me explain. Here's a little timeline of how I got to this conclusion. 2018, Jerome Powell, the Fed chair, raises the 10-year Treasury note interest rates 4 times in 2018 and signals that he will raise the rates 4 more times in 2019. The stock market then promptly plunges into the first bear market since the Great Recession 10 years ago. All 3 major U.S. indexes closed the year in the red. The Dow Jones lost 5.63%, the S&P 500 fell 6.24%, and the Nasdaq declined 3.88%. December 19, 2018, the Fed now projects only 2 interest rate hikes in 2019 instead of 4. President Trump, meanwhile, says it is incredible that the Fed is even considering yet another interest rate hike. January 4, 2019, Jerome Powell now says, "We will be patient as we watch to see how the economy evolves." Stocks promptly take off like a rocket. And when I say take off, I mean they go up a lot. January 9, 2019, the FOMC, which is basically the Fed, the meeting minutes say that the Fed can afford to be patient about further policy firming. There's that word patient again. A few days later, there is some commentary from the former Fed chair, Janet Yellen. January 14, 2019, Janet Yellen suggests the possibility of no rate hikes. Goes down from 4 to 2, and now Janet Yellen's talking about none. The possibility of no rate hikes in 2019. Quote, "If there is a downturn in the global economy and that spills into the U.S., it's very possible we may have seen the last interest rate hike of this cycle." January 30, 2019, the Fed chooses not to raise interest rates. Powell says, quote, "The case for raising rates has weakened somewhat, and the committee vows to take a patient," there's that word again, "approach toward further hikes." January 31st, 2019, the S&P rose nearly 8% in January. It was the best January for the S&P 500 in 32 years, since 1987. And that's after the Fed decided to ease up on rate hikes. February 6, 2019, Janet Yellen suggests the possibility of rate cuts in 2019. Quote, "If global growth really weakens and that spills over to the United States, where financial conditions tighten more and we do see a weakening in the U.S. economy, it's certainly possible that the next move is a cut." And February 7, 2019, the European Union trims its 2019 Euro area gross domestic product GDP growth forecast from 1.9% to 1.3%, indicating we're seeing a slowdown in global financial conditions. So here are my conclusions. Jerome Powell was the first Fed chair since Paul Volcker to make an earnest attempt to raise bond yields. Volcker raised the 10-year Treasury yield above 15% briefly in 1980. Powell couldn't even get it to 3% without causing a bear market in stocks. Besides, the president, like all presidents since Paul Volcker, didn't want the Fed to meaningfully raise bond yields. There will be small Treasury yield increases here and there, but a substantial and lasting rate increase is pretty much impossible now. That's just my opinion, based on these facts I've given you. The days of retirees being able to avoid the risky stock market and opt for a fairly safe, and I should put that safe in quotes, but relatively safe 5% bond investment return that at least keeps up with inflation, those days, they're long gone. And incidentally, Paul Volcker is still alive and well at 91 years of age, and he sees, quote, a hell of a mess in every direction. And here's the man himself, Mr. Paul Volcker. Well, I'll let you decide what you think of all this. Am I right? Am I wrong? It's just a theory. I'm not saying that they'll never make any small bond yield increases. Oh, sure, they'll do a few token increases here and there, but because of presidential pressure, not just from Trump, but from presidents past, present, and future, and because the stock market has a hissy fit with any meaningful or substantial or lasting bond yield hikes, because the stock market views bonds as competition, I don't expect to see, at least in my lifetime, anytime soon, real action, meaningful action on the part of the Fed. The Volcker spirit, well, the man is still alive, but the spirit is gone from the Fed. Looking at the markets, David Modell. Talk to you soon.